Friday, November 8th, 2024, Monaco 64, home of alternative economics and contrarian views. So it's Friday, so it's the day we chat with Clive. Hi, Clive. How are you?
Good morning, Mario. I'm well, thank you. How are you?
Yeah, like you said, winter's coming here as well. It's getting the days are getting shorter and colder. But anyway, uh, why don't we start with the Federal Reserve, the FOMC, let's say press conference and announcement. They cut rates by 25 basis points. Uh, I thought to myself, I even tweeted Clive, and I'll bring it up. Let's have a look. Where is it? Uh, and see what you think about it. Hold on. Let me share it. I said here, let me move this. One cannot expect the fiat currency to gain value when the central bank is accommodating while the stock market is at all-time highs. The economy is supposedly growing at almost 3%, and Congress is running a 6% budget deficit. And I said, got gold. So I got quite a lot of likes here for me. I mean, my X account is not that big. I've got like 20,400. But what do you think about that, Clive?
Well, I read this morning that if Trump renews the tax cuts as he is planning to do and as he promised to do, that budget deficit will run to 12% of GDP. In other words, it's going to be doubling as a percentage of GDP. And obviously, 12% is a pretty big percentage of GDP to have as a deficit. Um, yeah, so I think it's quite worrying for the rate of inflation because the way out of that is for the government to borrow more and more.
Yeah.
As the government borrows, it gets poorer and everybody else gets richer, which means there's more money to buy the assets, which means the prices of things go up.
So, Clive, if that's going to go to 12% of GDP, the deficit, and I think in 2020 it was almost 15, and then 2021 it was around 12. And don't forget, in 2020, Trump was in power. Yeah, Biden was in power in 2021. How can Trump say that he wants to bring inflation down? Does he think that by cutting taxes, the economy will grow and they'll have a lot more tax receipts to cover that deficit? And do you think that's possible?
Well, actually, that's what he said when he was campaigning, that he'd stimulate the economy and they'd have higher tax receipts because of it. But, he's doing other things which are going to be inflationary. For one, he's promised mass exports of immigrants. I don't know what sort of immigrants he's going to get out, whether it's the illegal immigrants or the legal ones. But anyway, he's talking about getting rid of a lot of immigrants and very, very quickly. He's going to put tariffs on various overseas goods. So all of that is inflationary because if you get rid of the immigrants, who for the most part are those who are appearing as having got the jobs, so the native born Americans, there's less of them with jobs. Um, it does mean that the wages are going to have to rise to get people into the marketplace to do the work. So that's that. And then, putting tariffs, who does it hurt? Does it hurt the exporter in China or does it hurt the American consumer? Well, of course, it's going to be both of them. The American consumer is going to have to buy his goods from somewhere else, probably from an American manufacturer, where it's going to be more expensive than getting it from China. So it will be inflationary.
Yeah, and I saw this guy here. He tweeted, he's called Darth Powell. And he said, reminder, Trump doesn't keep promises, he just lies to gain power and wealth. And I'm not taking positions here. I'm just looking at the numbers and what has been said. I personally think Trump is the better of two, let's say, evils than Kamala Harris. But anyway, probably get a lot of stick for this. But if you look at it, this was Trump in 20 October 10th, 2016. And he said Paul Ryan should spend more time on balancing the budget, jobs, and illegal immigration, not waste his time fighting Republican nominee. And then he says, This was what, 2012 actually. Said no member of Congress should be eligible for re-election if our country's budget is not balanced. Deficit not allowed. So this guy says, the debt grew 8 trillion when he was in power. And even, that was the COVID. I guess you could add maybe 4 trillion or 3 trillion more. Even without COVID, it would have been up quite a bit. So yeah, I'm thinking here, how are they going to bring inflation down and keep all these promises? And I think you've heard as well. I think earlier this year he said he's going to honor all the unfunded liabilities, which are here, Clive, the 220 trillion. Of course, this is not all at once.
Well, where is he going to honor it from? There's no money in the coffers of the Treasury to pay those liabilities. So the only way to get it is to borrow it or print it.
Yeah. Uh, so I mean, the U.S. Constitution, Clive, doesn't really talk about a central bank. And there was a question for Jay Powell. I think it was from someone yesterday at the press conference, and I'll play it here for you and for the viewers.
Um, some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
The clip you just saw, I'm about to play the full clip in a moment, is from just a few hours ago, where the head of the Federal Reserve at a press conference was asked, if Trump tells you to step down, will you? And he says, no. And people are blown away saying, wait a minute, the president can't remove somebody? And that's actually the truth. The president cannot remove the head of the private Federal Reserve set up in 1913 that Ron Paul and countless others have been.
There you go. So I would argue that, yeah, the Fed, the 12 regional banks, Clive, they're private. The Federal Reserve Board in Washington, D.C., that's a government agency. So it's like a hybrid. And what I think should happen in monetary policy is that the market decides what the rate of interest on loans are going to be. So Congress, not apparently, but Congress only determines the weight and composition of the coins, gold and silver coins, but monetary policy is normally left to the market. But now it's left to like a monopoly and a central bank where the chairman cannot be removed, even though it was actually Trump who nominated him as chairman in 2017, but it was Obama who nominated him to the board of the Federal Reserve in 2012, and I think his term runs out on as chairman on in May of 2026. So yeah, unless he resigns, yeah, Trump is stuck with him. But I always remember Trump criticizing him for not cutting rates. And if you want to cut inflation, do you really want to cut rates? He should be raising rates. So it's really confusing. Just want to
Well,
your view on this.
yeah, well, Trump has got a vested interest in seeing lower rates because he owns 40 Wall Street, where occupancy has fallen from 98% in 2015 to only 74% at the moment. That's in June. And Trump's got a very large loan on that property. But according to the latest reports that I read, the rent coming in is only covering 62% of the loan servicing cost. So, if Trump could get the interest rates down a little bit more, perhaps he'll be covering his costs.
Yeah, and I wonder if all his other businesses are that leveraged. He has a lot of properties.
Oh yes, they will be. I mean, this is the way businessmen do make a lot of money. You either use other people's labor or you use other people's money. And in Trump's case, it's both.
Yeah,
So he's borrowing it. Yeah, he's borrowing left and right and center. I have no doubt at all.
yeah. And I did a bit of research, Clive, and the last, I think, chairman of the Federal Reserve that didn't complete his term was G. William Miller. He was appointed chairman of the Federal Reserve in 1978, and he left in 79 because he was, I don't know if you can call it promoted, but he became Secretary of the Treasury under Jimmy Carter. So, and then Paul Volcker came in. So I wondered if Jimmy Carter said, "Would you, can you please leave, and then I'll give you the post of Secretary of the Treasury." And I think maybe Paul Volcker. I think did he? Let's see. When was his last? Well, he was there from 79 to 87. So that's yeah. He did his 8 years. Or I mean, now it's 5. I'm not sure. Maybe he left early and then came Greenspan. And talking about Greenspan, Clive, I wanted to play you this. This is quite interesting. And he notes that the Fed is the only independent agency. So here we go.
What is the proper relationship? What should be the proper relationship between a chairman of the Fed and a president of the United States?
Well, first of all, the Federal Reserve is an independent agency, and that means basically that there is no other agency of government which can overrule actions that we take. So long as that is in place and there is no evidence that the administration or the Congress or anybody else is requesting that we do things other than what we think is the appropriate thing, then what the relationships are don't frankly matter. And I've had very good relationships with presidents.
So there you go. He said the Fed is independent. And so why do you think instead of raising rates to basically stop Congress from spending and borrowing? Why do they cut rates? Is it because maybe ultimately the Federal Reserve was created by an act of Congress? So the way Powell sees is that even though he's supposedly independent, he's got to help them out.
Frankly, I don't believe that the Federal Reserve is completely independent. There's several examples in history where the Federal Reserve has not played ball and then has been told what to do. In one case, it was by act of the government, and in another, it was basically in the 1950s when they were being told to buy government bonds and they didn't want to, and basically they ended up being told what to do. So I personally think that even though they claim their independence, I think they're going to toe the line to a large extent. Of course, they're going to play their game that we're independent, we won't do as we're told, but I think behind the scenes they are. And if the government gets into a fix because it can't borrow any more money, and it's likely to get into a fix because, frankly, that budget deficit is going to get bigger and bigger. The debt is going to get bigger and bigger. It's forecast to reach 200% of GDP. This is by the Congressional Budget Office. 200% of GDP in 2051. It's now 120, something like that. So if the government gets into problems, not being able to raise money by borrowing it, who's going to step in and lend them the money? It's going to be the central bank. And if they fail to do that, well, there'll be complete chaos. And I think the Federal Reserve would see that as much as the government can see it. So yes, I think they'll agree to do what's best for the country, i.e., lend the money, and that means the Federal Reserve prints the money, electronically prints it, gives it to the Federal Reserve. The Federal Reserve gives it a bond in exchange. The Federal Reserve is now poorer, and everybody else is richer, and the balance sheet of the Federal Reserve is bigger.
Yeah.
So that's the way I see it playing out. And I think that crisis will come possibly late next year, maybe the year after. But I don't think we're far away from that.
Yeah. So do you think anything changes with the new administration coming in January in terms of the the markets, let's say interest rates, the debt, the deficits, and also business? Do you think, I think Trump might be better for business, but do you think that the talk of cutting the size of government with Elon Musk at the Department of Government Efficiency, do you think it's too late for all that? Because the debt is so massive that, yeah,
And
I
well,
can't see
I,
that
I,
happening.
I believe we passed the point of no return already. So I don't think they can go back and start reducing the level of debt versus GDP. I don't see that happening there because they'd have to raise taxes massively beyond the level which is acceptable to anybody in America, including the congressmen themselves. Or they'd have to cut spending and have civil war on their hands as they cut benefits, and that would be a huge cut. So I think the level of spending is destined to rise anyway because of the rise in interest costs. So the interest costs of the national debt are rising very rapidly. That's not going to go away. There's nothing they can do about that, unless perhaps Federal Reserve cuts interest rates to zero. But that's not helping at the moment because, as we have seen, despite starting to cut rates a few months ago, the interest rate on the 10-year Treasury and other maturities, which is where the government should be borrowing, has been rising rapidly. I can share this with you if you like. I just got the screen up here. Let me
Yeah.
bring that up. So if you see the chart here, this is the interest rate on the 10-year Treasury. The two white lines, the first one is on the 17th of September, the vertical white line. That's when they first cut rates by 0.5%. And the interest rate at that time on the 10-year Treasury was around 3.61%,
Yeah.
give or take. They cut rates by 0.5%. Interest rates are now 4.3%. So that's gone from 3.6 to 4.3. That's 0.7% higher. And in between those two times, we've had yet another cut yesterday. So we've had 0.75% cut, and the 10-year Treasury interest rate is up nearly 0.75%. So the market is making its own decision as to what the interest rate should be, and the same thing is happening in the UK. If I just move the
Yeah.
chart over to the UK here,
Yeah,
um,
they cut rates yesterday as well, and
yeah. So you see the first cut back at the beginning of August is here on the left-hand side. Interest rates were around 3.9%, give or take. It went down. They actually, at one point, were down to 3.8%. But we're now at 4.5, over 4.5% in the UK. So again, despite two cuts in interest rates in the UK, the 10-year yield has risen. So the market is making its own judgment of where rates should be. And what this means for the man in the street is his mortgage costs are going to be more expensive than they were before they started cutting rates.
Mr. Trump's mortgage costs are going to be higher too, aren't they?
Yeah, if he rolls over his loan, if it's a
Yeah.
fixed term loan, yes.
Yeah. And I'm sure you remember the bond vigilantes from the 70s and even the 80s to some extent. Do you think they're back because they were in hibernation, let's say, from the mid 90s up until 2, 3 years ago?
I do. The word bond vigilantes basically means that when something is not working right, you'll see it in the bond market first. Bond market investors are far more sensitive to things which are going on than equity investors, who always see the optimistic side of things, that they assume that the board of directors of a company will navigate its way out of all the woes of this world. That obviously is to a large extent true, but bond investors are, they don't have too many things to look at. It's basically just the economy and where the interest rates are, where they will be, and where the inflation rate's going. So what the bond vigilantes are saying to us is that they think that inflation is not over. They think that inflation is going to come back, and probably come back with a vengeance.
The other thing, Clive, that people say, oh, we're going to bring inflation down, but even Trump, or let's say Harris or Biden, but when they say that, they mean that they're going to bring the rate of CPI down to 2%. We know that that rate is highly doctored and has been changed over the decades. And the other thing that very few people talk about is the fact that the CPI index itself that has been growing over the years. So let's say it was 100 20 years ago and now it's 200. 2% of 200 is a lot more than 2% of 100. So, and the only way to really bring prices down to where they used to be would be to have a Great Depression. So, yeah, I don't see any way out. And I think what Trump is promising to do, which in a way is not a bad thing, cut regulations, cut taxes, get people and businesses flourishing again. Yeah, that's all and good, and cutting the size of government, but it's much easier said than done. And I think maybe if that was done 25, 30 years ago, that would have been still doable. But now with the debt to GDP of the government and the private sector being so high, I think it's going to be really tough.
Yeah, I mean, as I said, I think they've passed the point of no return, and they're actually budgeting for that to get a lot worse. You only have to go to uh, website, the Bureau of Labor Statistics, is that the one? No, the Congressional Budget Office, the CBO, and you can see their official numbers projected out forwards, and it's looking pretty dire. That's the official budget of the government based on everything that they know.
Yeah, let's have a look here if I can find that CBO projections.
Oh, well, yeah, looking.
It's budget.
So while you look, I'll just comment on something which happened
Yeah.
last week. Uh, I got a lot of messages coming in, probably two a day, maybe more, from your listeners saying, I'm very nervous about the stock market. Should I sell my shares? Or I'm going to sell my shares, or I have sold my shares. I'm waiting to buy them back a lot cheaper.
Yeah.
And a lot of people are asking me what to do about it. And I said, but obviously I didn't know what's going to happen, but I did say my advice is if you feel nervous, you go ahead and sell some, but don't sell everything because you might have a move in the opposite direction. And I did say to everybody, I'm not going to be selling any of my shares at all, and I haven't. Uh, well, what we saw immediately after the election of Donald Trump was quite a spike in stock markets. They literally went through the roof, celebrating his win. So yeah, it just goes to show markets don't always do what people expect.
Yeah, I haven't found maybe we'll look at it later, but
Oh, I can find
have
it
you
if you
got
like,
it? Yeah.
Mario. I haven't got it in front of me, but I can bring it up quickly.
Yeah.
So this is the CBO bookmarks budget. Then I go to congressional the economic data. I think that's the one. Long-term budget outlook. That should do it. Give me a second. And yeah, okay. So let me just
Are you
show you
are
that
you good
page.
at are you good at multitasking? I want to ask you a question in that.
uh, Probably not as good as I'd like. So
Yeah,
let's have a look. But
I'll wait then.
yeah,
Well, there you go.
there's that. Now that says the long-term economic by fiscal year, and you can see here this was from March 2024. It's
Yeah.
not the latest version, but it shows.
Can you enlarge it a bit, Clive?
Yeah. Oh yes, so sure.
A hundred, it's 100% if you could.
Yeah, let's make that 200%.
Yeah, that's better. We can see it now.
So the long-term budget outlook. So they had the 2023 numbers showing a deficit of how are they expressing this as 6.2% of GDP. According to this, it stays fairly constant. But what I read in the newspaper this morning is that under Trump's new plans, it's going to go to 12% of GDP, the
Wow.
deficit.
Where did you read that, Clive?
I can't tell you. It was probably the Telegraph, but I was also
Yeah.
reading Bloomberg this
I
morning, so I'm
mean,
not sure now.
6.1 deficit is already huge. That's what governments spend probably in a recession to, it's the old Keynesian spend during a recession. But uh, ideally, the budget should be balanced, but that hasn't happened in over 50 years, I think. But like in the Eurozone, like in Europe, there's a 3% limit. So that's pretty amazing there. And
I was trying to bring that one up, but it's the late that one's actually a spreadsheet, so I can't bring that
yeah,
one up very quickly. Okay, sorry, I'll exit the sharing.
all right. But anyway, the fiscal situation is pretty dire. Um, and I think people are going to be shocked because I understand that a lot of people are happy that there's a new administration and things might get better. And it's interesting that usually if the economy is doing well, you get the same party win again because it's there's the old saying about it's the economy, but it didn't seem to work this time. But at the same time, I think we could be in for a rude awakening. Do you think the period from now to January 20th could be quite volatile for the markets? And another question I wanted to ask you, Clive. We saw gold and silver get uh, a big correction on the day after the election, probably needed to correct a bit. Excuse me. So, are you getting rid of all your gold and silver now that everything looks fine with Trump in, or are you continuing?
Oh yes, absolutely, Mario. I always panic the minute anything goes in the wrong direction. I immediately sell at the bottom, and the wait to go up again. Then I buy. I say, "Oh God, I got it wrong," and then I buy it at the top. That's absolutely the way to play the game. I'm of course joking here. So no, I've been a net buyer. Not I didn't buy on the dip. I have to say because it's now recovering from the dip. Um, there were obviously a lot of people who were hoping for that, and one of the reasons why the gold price went down was Trump. His planned tariffs on other countries mean that Americans will buy less overseas goods, which means there'll be less exporting of the dollars. Therefore, the dollar should, in theory, if you ignore all the other things, should in theory rise. And so that's what happened. The dollar, if you look at the DXY, the dollar index did in fact rise. It's now coming back off. But as the dollar rises, the things like gold price fell. It didn't fall nearly as much in other currencies as it fell in the in US dollars. Um, so that's why it happened. But of course, what's going on with gold is a much more fundamental story of central bank buying. And I've got a little story for you here, which I did some research this morning and last night about China's buying of gold. Can I share my screen again,
Sure.
Mario?
Yeah.
Let's just do that. Give me a second. I'm going to show you the how China has been increasing its gold holdings. It's this one. No, it's this one. Share. Let me go here, bring this up. Are you able to read that? Is big enough for you, Mario?
Yeah, that's big enough. That's fine.
So what I'm looking at here is a table of China's reserves going back to the start of 2023. That's in the left-hand column, and it's showing 33 trillion going to 35 trillion. Then the amount of gold held, and that's in millions of ounces.
Hmm.
So in January 2023, China held 65.12 million ounces of gold. Now, nearly 2 years later, they hold 72.8 million ounces, which is around 12% more ounces than it held nearly 2 years ago. But in those 2 years, their total reserves only rose 4%. So reserves up 4%, but of those reserves, the exposure to gold in number of ounces went up by 12. So they're obviously putting more gold in their portfolio in terms of ounces. And interestingly enough, the value of that gold today is worth 59% more than it
Hmm.
was in 2023.
Yeah, and
That
the value of China's gold reserves have gone up as well. They're the last column by 52%.
That's right. So what's happened is China's exposure to gold in its reserves, although it's only around 5.6%, but it was a year and a half ago, 2 years ago, 3.7%. Although it's only 5.6%, that number has gone from 3.7 to 5.6, and I think it's probably going to increase. But we're not really talking about China. What I'm talking about here is that China is setting the way for the way other central banks might be behaving in the future. So, all central banks know that gold has perpetually been a store of value. And they can also see that the global monetary systems today, and has been for many, many years since they went off the gold standard, still relying on the gold standard.
I stopped sharing. I just want
Oh
to
yeah,
that's all right.
that's no problem.
I just wanted to
That's,
also that it's not just China that's buying gold, but Poland.
it,
Uh,
it,
it just came out yesterday. National Bank of Poland indicates that its gold reserves rose by a further 7 tons in October. Year-to-date net purchases now total 68 tons, helping lift gold holdings to 427 tons, 18% of total reserves. I think a lot of these countries want to get up to around 40%. So I think they're going to continue to increase. And Clive, I saw from that set of data from China that they've stopped adding since May, I think, this year. But some people speculate that they did that because the price was rising so quickly, and they're doing it behind the scenes through some of their state-owned enterprises. Do you think that's a theory that holds water?
well, the value of their gold reserves has risen literally or virtually every single month in dollar terms,
Yeah,
going back for 2 years. I think there was 1 month when it went down very, very slightly, not because they sold any gold. They actually bought gold in that month. So the gold price went down. They took advantage of that to buy more gold. But the value of that gold, and maybe I'll just bring up the share again to
yeah,
show that. So we're looking in where my mouse is at the top right-hand corner. That was in February 2023. As you can see, the value of the gold fell from 1.9 trillion US dollars to sorry, that's not big one. It's from from 1.2 trillion dollars or 1.25 trillion dollars to 1.2 trillion dollars. But that was in a month when they increased their holdings of gold. So
yeah,
as the price of gold went down, you see it went down from 1,900 to 1,800. As the price went down, they bought more gold,
yeah,
as you can see in the middle column.
yeah,
And so what I think is happening here is when the gold price rises sharply, China holds off on buying
yeah,
gold, but on the dips, it comes in and buys gold. And the reason it hasn't increased its number of ounces in the last few months is because the gold price has literally been higher every month without exception. If I just look at the last few months, June it was 1696, 169. No, the gold price, not big one. Going back to the gold price, going back to January it was 2,000. By March it was 2,200. By June it was 2,300. By September it was 2,600, and in October the price they used was 2,700 and something, 2,734. We're currently in the 260s again. So I rather suspect that the recent dip is an opportunity for them to now actually increase their gold reserves a little bit more.
yeah. I see that right now. Gold. I mean, last night gold got back up above 2,700. The low was like 2643, so it's a bit more volatile. Right now, it's 11 past 9 London time, and it's 2690. It's down about 16. And Yeah, talking about gold and China buying gold, I I bought some sovereigns last week from Gold Investments, uh, who are an affiliate of the channel, and I went to pick it up yesterday. I went into London with my wife, and we had some lunch as well. And a lot of the viewers sometimes, if well, not a lot, but some send me stuff to gold investments because I don't really want to give my home address, and a post office box in the UK is not worth getting. They charge too much. But I had a few things that people sent me, Clive, aside from getting my sovereigns, and this is one of them. It's a 2016 gold sovereign, and it's in mint condition, actually. Yeah, I was presently surprised. One of the viewers sent me this coin here. It's a 1 ounce silver coins, and it says "Paper is poverty," and it has a skull, and it looks like a George Washington, but it's a dead skull, I guess. And on the other side, it says, uh, what does it say? Tyranny, restore tyranny, prosperity, and liberty. So there you go. Quite a
So,
nice coin.
so like me, Mario, you're also buying gold even at the higher prices, even though you're probably paying 10 times what you paid for your first piece of gold.
Oh yeah, definitely. And I mean, I bought some gold like 2 months ago, and the price now is a lot higher. The price that I paid for the gold I picked up yesterday has gone down, but I don't really worry about it because I think the best time to buy gold and silver is whenever you can, whenever you're comfortable that you have enough fiat cash you know, uh, to pay your bills and to have it for emergency. And that's what I do. The other thing I got, Clive, was, and I would like to thank all the people that sent me stuff, and also Pete. I think he's from Massachusetts. He sent a really nice card as well. It has a quote from Marcus Aurelius, and it says, "Each day provides its own gifts," which is quite nice.
That's beautiful.
Yeah, but he sent me this, Clive. Colonial and Revolutionary Currency, 1773, 1781. Antiqued reproductions. They look old and actually feel old. Uh, it's not empty, it's just that I've got them here. And do you mind if I read through some of them?
Yeah,
Because
yeah,
it's
that'd be
really
interesting.
so here I've
So
got
this is old colonial money from what year, Mario?
1773 to 1781. So a lot of these became what they called shin plaster, because they issued so many of them during the Revolutionary War. And after it ended, they never paid the silver or the gold. So they traded below par. So there's a note saying not worth a continental. But let's read this one here, and it's 10 shillings. So they still use the term shillings in the colonies. It says, "The possessor of this bill shall be paid by the treasurer of the state of Connecticut 10 shillings in Spanish milled dollars." So that's silver at the rate of 6 shillings each, and other silver or gold coins equivalent with interest at 5% per annum by the first day of March 1784. So this was issued in 1780 by order of the Assembly, dated Hartford, first day of June 1780. So basically, this is like a 4-year bond, but that so
And the reason they say paid in silver or gold was because there was a fixed rate of exchange at the time between silver and gold. I don't know exactly what it was, but I suspect it was around 15 or 20 times.
yeah. Oh, there's an interesting one here. It's a bigger amount. Uh, I'm gonna read it. $250. This bill of $250 shall be exchanged and redeemed in Spanish milled dollars or the value thereof in gold or silver at the rate of 1 for 40 at the Treasury of Virginia, or on before 30th day of December 1792, according to an act of assembly passed the first day of March, 1781. So yeah, it's the Virginia currency. So there you go.
It's one of the many examples in history where people owned government paper and never got paid.
Yeah, and don't forget, I know a lot of the stuff we do these days is digital and on the internet, but we still deep down we have government paper and they still call it dollar bills. And that's why people say that paper always goes to zero. I mean, this stuff went to zero. I think they have only got, well, this is reproduction, but there are some original ones that are worth something, but you can't get the silver or the gold anymore from them. So what's the lesson here, Clive?
If you hold the promise of somebody else who can't pay, maybe they won't pay.
That's right. Yeah. And the other thing as well, I think yes, they probably resorted to patriotism or patriotism. You know, we're fighting the British. We need to uh, help the Continental Army. But when push comes to shove, they'll take your money and they will default on it. Do you think that this kind of thing could happen again now, seeing that things are getting so topsy-turvy out there?
I think default by a country which can print its own money is very unlikely because they'll just print it. But there's plenty of other options open to a government when rather than actually defaulting. Um, they can they can stop you using your money. They can put restrictions on what you do with your money. In other words, that could be wage and price controls, it could be exchange controls, it could be capital controls, or it could be that they issue a new type of currency, a bit like ration coupons, where you can't spend your money unless you've got the ration coupon to go with it. I call it ration coupons, but we're not really talking about ration coupons. We're probably talking more likely the central bank digital currency, where they say, unless it's in your CBDC wallet, you can't spend it. And here's the restriction. You can't put money into your CBDC wallet unless da da da. And they bring in some rules. But basically, the rules can be made up as they go to ensure that the economy and the inflation is not being destroyed by everybody trying to spend their money on everything. They could also bring in what's called a bail-in. A bail-in is where the government requires those who hold cash in the bank to lend it to the government at a predefined interest rate, and you get it back in a few years. But of course, by the time you get it back, it might not buy much. So default, I don't think is the option. But the traditional solution to too much debt is to inflate it away. You inflate it, inflate it, inflate it. Eventually, the point comes where the old currency is almost worthless, and you say, right, we're going to restart the system. We'll issue a new currency. We'll knock off 10 zeros from the banknotes, and or 10 zeros of the digital notes. We'll have a new dollar, or a new pound, or a new euro, and each new euro, you get one for every 10,000 of the old.
Well, I think the other option is what's happening now, de facto, is to devalue versus gold, and then readjust let's say, the statutory price of gold. In the US, it's still $42.22. And seeing that a lot of countries like China, Russia, and many others are buying gold, uh, I could see the US coming out and especially with the fiscal problems, revaluing the price of gold, not just in the market, but also at the statutory price. That would pad up the Fed's balance sheet massively because they've got those gold certificates, but they're only valued at $42. And I'm reading a book here now, Clive. It's called As Good as Gold, Judy Shelton, and she was nominated to the board of the Federal Reserve by Trump in 2019, but the Senate blocked her because she's a sound money proponent. And I haven't finished the book. I'm almost there. I'm in the part now where she's proposing a treasury bond, and I want to see what you think of it. Instead of it being the tips, the treasury inflation protected bonds, what she's thinking of to back the dollar by gold is having a treasury bond where, let's say, you pay $2,700 for one bond, and it's a 10-year bond. And in 10 years' time, you can either get $2,700 in paper, or you can get an ounce of gold. which sounds quite interesting. And she thinks that will stabilize the dollar and give it more confidence. So if you buy a bond today at 2,700 and in 10 years time the gold price is at 30,000, yeah, you're going to ask for the ounce of gold, not the dollars.
I have some of those bonds, not issued by the United States, but issued by the pre-communist government of China. They've still got all the coupons attached to them because they never paid me anything, or rather,
Yeah,
my
I,
ancestors.
I don't know if I still have to read it, but I don't think there will be coupons. It's not going to pay you
Okay,
interest
yeah.
in gold. It's just gonna the price is just gonna adjust. So I don't know. Um, is she
I
going to
think if the
dominate it
promise
again?
was if the promise was plausible, I think people would buy the bonds, but there would be no interest in the government issuing those bonds when the price of gold's at 2,700. They'd have to increase the price of gold to sufficient to cover the national debt. Then they would have a plausible promise to say you can redeem our national debt or you can redeem our money in gold if you so wish. But if they had any other price, people would say, well, it's all very well you making this promise, but you don't have enough gold. Why would I buy your bond? How are you gonna redeem everybody?
Yeah, the the idea behind it is that you buy it's just like a normal treasury bond, but it has a gold call on it. So if you want to participate in gold going up, you actually don't mind buying it at 2,700 because it's worth an ounce as well. But uh, she assumes that the US has 8,100 tons in Fort Knox. So I'm not sure, and if that will
So
that's
what
the
would
case.
happen if they issued more bonds than they have gold in Fort Knox? I mean, because the amount that would represent, I think it's 500 billion or something like that at today's price, maybe it's 600 billion. It's not a huge amount compared with the national debt of 30 something trillion.
Yeah, but that's at $42 dollars.
Oh no,
Oh,
$42.
no,
It's no $40. It's something like 28 or 30 million dollars.
no, but
To a
could be
billion
more.
dollars. Yeah,
Yeah.
but $1 billion. But to get to the to 500, so to get to the $500 billion, you'd move the gold price up to 2,000 something. Well, I suppose it was 500 billion was
Yeah,
2,000. Now it's probably getting on for 800, 900 billion, but
yeah,
it's still only a drop in the bucket compared with the national debt of the Treasury, which
yeah.
is
I
34
I
trillion.
don't think the idea is to have all treasury bonds be like have a gold call, a gold option, but some of them, because like the tips now, I think they're 2 trillion, 2 trillion in tips. Uh, but I guess if they do want to back everything by gold, then the government will have to start saving and having a surplus and buying gold with that surplus. And that's what usually happens, right? But as we know right now, that's going to be almost impossible. So we're gonna, yeah, we're gonna stop here now, Clive. We've gone on for a while. Just wondering if you want to tell the viewers a few final thoughts, and maybe tell them where they can get in touch with you.
So first of all, the image you see on the screen behind me, that's the Chinese lunar snake. 2025 is the year of the snake. And I put it up there perhaps to talk about the possibility of, which I won't do now, but other central banks doing what the Chinese are doing. And you mentioned Poland's already doing it, of buying gold, following the lead of China. But anyone who wants to write to me with a question, I'm on LinkedIn, and thumbs up to everybody.
Yeah, and Clive, thanks for coming on Friday again. I always enjoy speaking with you, and I like to wish everyone a great weekend. And just wanted to let you know that today I'm going to do the Mike and Mario show again. That's going to be at I think 4:30 p.m. London time, so 11:30 Eastern time. And unfortunately, I won't be doing the live stream on Sunday because I'm going to be away. So, Clive, have a great weekend, and I'll talk to you next week.
Thanks, Mario, and thanks to all your listeners.